Hey guys, good evening. This is Angelo Christian coming to you, talk to you about conventional loans this evening, and want to explain to you how conventional loans work and the reasons why people do a conventional loan versus FHA or VA or USDA. Explain the benefits and the requirements for them, and when and how you'd want to use a conventional loan. So basically, conventional loans are typically considered to be for better credit customers. Generally we want to see a 660 or higher credit score for conventional. That starts with 3% down for a first-time buyer. The 3% down program is for first-time buyers only, and it has a maximum debt ratio of 41%. So that's the most that you can go up to for conventional. And so there's other down payment programs too. There's a 5% down, there's a 10% down, a 15% down, and 20% down. And so generally for like the 5% down, the 10% down, 15% down, the maximum is usually around 43%. It can go up to as high as 50%. It's all based on what DU says. So whatever DU says is what's going to be acceptable, but generally that's the norm. Just the back of the envelope, ratio calculation. But like I said, if DU approves it at a higher one because of the credit score or the down payment, then it's possible to go up to 50. So that's something that's really cool. There are multiple PMI options. PMI is the private mortgage insurance, remember, and when you buy a home, it can be paid monthly by the borrower. It can be paid by the lender, or you can actually do a combo loan. We'll talk about what a combo loan is and explain that. There's no prepayment penalty on conventional loans that can be paid off at any time. There's no balloon on them. So, there's not like some type of rapid acceleration or amortization with a conventional loan. It can be paid off, just in a 30-year amortization, or if it's a 15-year, 20 or 10, or whatever the term is. And there's no prepayment penalty. Conventional loans are usually not assumable, like FHA or USD or VA. Conventional loans are not assumable, and with conventional loans, there generally is some recourse. If you do go into foreclosure, they could come back and sue the person for any type of deficiency that they weren't able to collect on the sale of the home. And so some of the other benefits, let's see here, clear this out. When you put up when you put down 20%, you do not have to escrow. Like you guys are used to doing FHA and VA and USDA. When you do a conventional loan, you put 20% down, there's no escrow required. And if you're in a community property state like we are here in Texas, and you don't want your spouse to go on the loan, then their credit for the non-purchasing spouse is not required. All right. So like if you're buying the house and you're married and you don't want your wife to go on the loan because she's got bad credit, if you're doing a conventional loan, we don't ever have to pull her credit. But like if you're doing FHA, you'd have to. And so the major advantage of conventional over FHA is the PMI can be removed when you hit the 20% equity mark. But with FHA, it cannot. With PMI for FHA, it's on there for the life of the loan. But for conventional, you can have that taken off when you hit that 20% marker. So that's a really cool thing. And so sometimes if you're, depending on who your servicer is, like we service our own loans, there's a possibility if you made all your payments on time for a year, you can request to have the PMI removed. There might be an opportunity to do that. So definitely check that out. And how you can calculate PMI, what I use, we use Radian for our mortgage insurance. And there's this cool website right here, radian.biz. And you can go here to kind of get an idea about what the monthly PMI would be for your customer. And what you do is you just go here to MI Rate Finder, and you do, here the borrower paid. Let's just say borrower paid. The borrower's paying the monthly PMI with their mortgage payment, and we do the non-refundable because it's a cheaper rate. And then there's no upfront, so don't click on this. And then you want to type in your state, which is Texas. Let's say the loan amount's 200,000, and they're putting 10% down. Type in 90% LTV. It's a 30-year fixed term. There's different MI coverages. 25 is usually the most popular. There's also 30 and 35. The minimum usually for most Fannie Mae programs is 25. So, and it's a primary residence. And, you put in like, single family, number of units, full documentation, credit score, debt ratio. You definitely want to have these selected. Who's automated underwriting, Fannie Mae, approve eligible, then you hit submit. And then it'll calculate it for you. It tells you that the PMI is 0.41%, which is very, very reasonable. So you take, the loan amount of 200,000, times, 0.41%, and that will tell you what the monthly PMI is, which is divided by 12 months equals 68.33 per month. So it's very reasonable for the PMI. And like I said, that's only on there for until you hit the 20% equity. So like we come in here and we change it to where, let's say that we do 5% down. And the guy's got a 660 score, and then you hit submit, the PMI goes up a lot higher, 1.42%. So 200,000 times 1.42% comes out to, $236 a month, just for a difference in down payment and credit score. So it went from 68 to 236. That's a 70%. I'm sorry, 200% increase in the premium coverage, just because of the credit and the down payment. So that's where you can check out to price the PMI. They're really cool. The other thing is with conventional loans. So if you're trying to do a second home, let's say the guy already owns a house and he wants to retain that house and buy a second home, and he's calling you for that, well, then it's only 10% down. Okay, 10% down for second home. But it must be in a resort type area. Like if you're buying a house, you're here in Houston, your second home has to be like in Galveston. It can't be like a mile down the road and you call that a second home. That's not acceptable. So investment properties, they start with 15% down, with 6 months plus reserves for 15% down. If you don't have that much in reserves, you can just do 20% down. If you're doing like a multi-unit, duplex, fourplex, those are generally 25% down. If they have rental income, then you can use that rental income. Let's say that you're buying a fourplex and they have tenants in there and it collects, $2,000 a month. You can use that income to help lower your debt ratio. They may want more reserves. In fact, they probably will want more reserves if you don't have experience as a landlord. They may want to see that you have more reserves just to cover the mortgage payment, just in case anything happens. But if you're collecting income off of it, it could be a good thing to help reduce the debt ratio. So that's kind of a cool thing. So basically, on the let's take a look at the guidelines on the matrix. and you have a copy of this matrix. It's always good to have this in front of you to reference. um, okay. So for conventional loans, like it says, max ratios are like around 43% with the DU approval. No manual underwrites are allowed with conventional. Okay. So it says here, what's the max DTI? Yeah, sometimes with a large down payment and high credit score, you can go to 50% debt ratio. So max concessions for conventional are 6%. Um, so usually that's the max that we do. I'm just reading this right here. It says if you do over, I think if you do over 90% LTV, the max is 3% concessions. If it's between 75 and 90, then I'm sorry, 75 and yeah, 90 is 6% concessions. So that sounds about right. Generally, the loan limit for conventional is 417 pretty much everywhere for the loan limit. Um, with the exception of high balance areas like in California and areas like that where it can go up to like 600 or 700. So check out the Fannie Mae or Freddie Mac loan limits just to make sure that the loan that you're doing is within the limits for that area. Most of the country is 417, but some of the high balance areas you can go higher. Um, the Fannie Mae DU, they like reserves. That does help with the loan to help it to go through. Reserves are very important. And so, let's see, MCC is allowed with conventional. It works a little bit differently though. It doesn't go on to a reduction to the taxes like it does with government loans. It gets added to the income. So if it's 166, you add that to the income. And so when you're running MCC with conventional, don't reduce it out of the property taxes, insurance, add it to the income because it does make a difference where you add it as far as affecting the debt ratio. Um, some other things with conventional loans. The For a bankruptcy discharge for let's see here, Chapter 7 conventional is 4 years from the discharge date. For a Chapter 7 total liquidation, like the other programs, it's 2 or 3. Um, for a conventional, the Chapter 13, 2 years from the discharge date for a Chapter 13, or 4 years if it was dismissed. Um, for foreclosure, it's 5 years or short sale 5 years. So you can see that right here. Okay. Conventionals and foreclosures, 5 years from the discharge date. With conventional, with grossing up fixed income, just like our other programs, you gross up 25% for like Social Security, disability, stuff like that. Anything that's non-taxable. There's a lot of misconceptions about conventional loans. If I do a conventional loan with respect to the appraisal, that the condition of the home doesn't matter, and that's not true. The condition of the home does matter. They look at that just like an FHA loan. FHA, may look at it a little bit deeper, but you still have to have a house that is in, decent condition, and some minor cosmetic stuff is okay, but they're still going to look at comps. They're still going to look at the any type of issues that the house may have, deferred maintenance or problems. We do allow escrow repair up to 5,000 with conventional. That means that if the house needs repairs, it can be added to the loan. If the house appraises out. For student loans with conventional, it's 1% of the balance or a fixed payment plan. Collections and disputes, you just follow what DU says for collections and dispute. When you run DU, it'll tell you if there's anything that needs to be addressed with those, or if it's going to be downgraded, or if they want the accounts taken out of dispute. But for student loans, it's 1% of the balance of or a fixed payment plan, just like USDA and FHA. So just keep that in mind. let's see here. For child support, you follow FHA divorce decree with a child support agreement. Don't need the 12 months cancel checks like you do with USDA. So that's with child support. For rental, you just follow what DU says for rental history verification or whatever DU says what we're going to follow. What else? I mean, we do a lot of conventional. We like them for, cash out refinances. If you do a cash out refinance with conventional, the maximum max LTV is 80%. 80% max LTV cash out. Regardless, actually, they do go to 85%. Okay, we can go to 85%, but if you do that, there's going to be PMI on the loan. So let me rephrase it. You can go to 85%. Texas is maxed at 80. 85% on all the other states, but you will pay PMI on the 5% portion. But Texas is 80%. So you can do a 15-year, you can do a 20-year, you can do a 25 years. All different types of terms are available, and you can price those in Optimal Blue. It just depends on what your customer. Obviously, the lower the term, you get a lower interest rate. And when you lower the term, like if you do a 15-year, the PMI is going to be cheaper for a 15-year than a 30. Lower PMI. There's generally not a upfront PMI on a conventional loan. Just the FYI. But they're really good programs. Again, the major benefit with a conventional loan over USDA, or I'm sorry, FHA, is that you can have that PMI removed. And so when you compare it, like I say, you do an FHA loan, versus conventional, you do, let's say the customer is, 700 credit, 200K loan, and putting, 3.5 down. So, and taxes are 6K. Insurance equals 2K. So let's just compare the scenarios here. So with FHA, the rate today is at 3.75. So the mortgage would be 926 plus the monthly mortgage insurance 0.85, 200,000. The monthly mortgage insurance would be 141.67. Plus escrow. See, taxes, insurance are 8,000 divided by 12, come out to 666 a month, equals $1,734. So he's got to pay that for as long as he stays on the loan. Okay. Whereas with conventional, let's say that the rate's 4%. So the payment's $954, and the PMI is 0.5 with his credit score. comes out to $83 plus escrow, $666 equals $1,703. So his payment is, $31 cheaper, but when he hits 20% equity, he can get this removed. Okay, so go from 1703 to 1620. So in the long run, he'd be better off, doing that. That makes sense, guys? Now remember, the guys that we're assuming this guy's got good credit, and it would make sense in this situation because he's got the credit and it makes sense for the guy to do. So there's another program that we're going to talk about. We said the combo loan. Basically, a combo loan is like the reason why people do that. It's a first and a second loan, so that way a person doesn't have to pay PMI. Normally, this works very well if it's a bigger loan amount. So let's say that we do the example of 400,000. I'll show you how this works. So $400,000 loan, 700 credit. So there's also a program with no PMI. So you have the option to buy out of the PMI. Okay, so these three options. So the first option, the combo, would be lent at 80% loan to value. So 400,000 at 80%. The first lien is for 320 with a 4% interest rate. So that loan will be for 80% of 400, which is 320. The payment's 1527. And then he's going to get a second loan for 10% or 40,000. And that's going to be at a 5.5% interest. The payment's 227. So the total here is 1754. Yeah. 40K down. Right? Now the other option is if you put 10% down, the regular conventional loan, be financing 360 at 4%. The payment is 1718 a month plus the PMI, which is 0.41% approximately. That would be $136. That comes out to 1854 payment. Okay, and the no PMI would be, let's say the interest rate's at 4.5%. The payment would be 1824. Now he's on this payment of 1824 for as long as he stays on the loan. After he has 20% equity here, you can get that removed, and his new payment would be 1718. Okay. Or after he pays off this second lien, his new payment would be 1527. He could double up on these payments on the second lien, just pay that off quickly, and just focus on the big mortgage and have a cheaper payment overall. So I would say either this option is good or this option is good. I probably would not do this. Either one of these is fine in this situation. Long term, this one's probably going to be better with a combo loan if you can pay it off faster because the payment will be cheaper. But either way, those are both good programs. So I hope that this is helpful on conventional loans, educates you on how they work. Use them. They're very good, very powerful when you're negotiating with good credit customers. And if you have any questions, you need anything, just let me know. All right, bye.